Good evening. Ira Epstein of Linn & Associates with your SPDR ETF video for this Wednesday, and we are now at September 23rd, 2020, getting on about 6:40 at night. So the settlement's already happened, but what a day of red. Look at this market. And I've got to tell you, the futures on the Dow down about 140. Silver's down $1 an ounce early on right now. We're seeing gold down another $10. So you're getting a break in these markets that's rather substantial. You're not seeing much of a rally in the bonds and the notes. And the only market in green today was TLT. So what's going on? In a nutshell, the market is nervous about COVID-19. I know you're going to say it's the election. I get it, and that is an element. I know you're going to say the Supreme Court fight. I get it, that's an element. But what I think's really at the heart of this is watching, as we keep seeing, the cases in France, Spain, the UK, Ireland specifically, and London. We're just seeing cases continue to grow and getting to the point where the exchequer in the UK was supposed to deliver his budget tomorrow. They put it off. They did it just hours ago. They have to deal with COVID in a different way and throw more money at it, so they're going to redo the budget. This is getting to be serious again. New York, what just happened? The mayor there saying Brooklyn, parts of Queens, there's other areas. The hot spots are appearing again. 35 states in the US are under quarantine rules. Folks, this thing not only hasn't gone away, now we're into that part of the year where the temperatures are going to drop, colds come, other parts, everything changes again. And I think the market, as euphoric as it was in August, is just taking all that premium out. I think we'll look back on it and say, okay, things aren't going to get as bad as they could have been. And I think that the question is, where do people want to start looking for value? I think that's going to show up quicker than you think. On the tech sector, once we filled this gap, we just died. The market's not going anywhere. What's the trend? It's clearly down. You have a pattern of lower highs and lower lows. To break the downtrend, the market needs to get over 114.51, the highs made on Tuesday. That would break the pattern and give you a minimum pattern of possibly even higher lows and a higher high, depending if the market breaks through the low of 109.11 or not. That would turn the downtrend and flatten it out. What about risk? Well, it's not, risk is the wrong word. What about where it might run to before it runs into a problem? And I think that would be the 116.83 level, the 18-day average of closes. Let's assume that doesn't happen. The market doesn't get over 114.51, but it wants to break instead. So we go looking for layers of where potential support is. We see the resistance as the 18-day, I believe that, because when the market is under it, it's often when you come back, that's a zone of resistance. You see that here. You got over it, you fell back to it, you fought under it, and then it eventually moved out. Go back and look on your charts. The next support in moving averages is the 100-day at 106.92, and well under that is the 98.43. Now, where I think traders that have been missed out on this summer bull market completely, they're waiting on this break now. It would not surprise me if they're just going to automatically start their buying campaign somewhere between the 100 and the 200-day average. Win, lose, or draw, I think they're going to start doing that one way or the other. There's just an awful lot of money out there that wants to do something. I don't say this lightly. I picked these numbers for a reason. If you look at the lower Bollinger Band, that comes in right against the 100-day average at this point. It can go under it, but it doesn't matter. It's a zone. And you haven't hit this lower Bollinger Band since back here at the end of July. And prior to that was March. So it gives me an idea that what was good back then might be good now for some technicians that go, you know, I've got money. I can't make money on my interest rate. That's for sure. You know, it's basically negative when you look at inflation. I wouldn't be surprised. Am I, as a chartist, a bottom picker? I am not. But do I expect to see short covering? That's what I do expect to see. So that's what I'm looking for. What about momentum? Well, when you add the slow stochastic, if we go back to yesterday, both numbers were not under 20. And the day before, let's get to that if I could, they were. The day before they were. So what the market had done and this is the key, it had an embedded reading. There we go. This was last Thursday. Both numbers not under 20. Friday, both under 20. Monday, let's get to that, both under 20. That's 2 in a row. And Tuesday, they were not under 20. You got what I'm pointing out here? Then they come back down, just like they're doing now. You're just oversold. It's not embedded. Embedded is the thing that would then get me even more bearish. Then I'd tone my words from looking here maybe much harder at the 200-day. I'm giving you the reasons why I'm thinking that is a zone. When I take a look at SMH, oversold, in a downtrend, under the 18-day average, the bias down, I'd look for support right here at 161.49. What will negate and hurt this market? Taking out today's high. Why today's high? Because it's an outside day down. And my theory is when you take out the high of an outside day down, at the very least, it creates a chart pattern that you go sideways on. But I'd be looking for moves back to the 18-day average and flatten out my thinking completely. When we come over to XLI, you've gone from upper Bollinger Band to lower band. You're still within this basic confine of the sideways action. It's widening out a bit, but it's not plunging, and you're oversold. So if you don't hold here, then I look for the 200-day average of closes in the gray line. The odds favor it's going to try to hold here. Again, a sign that the market is, for the moment at least, blown itself out will be in markets that had outside days down today, taking out that high on Thursday or Friday. Got that? That would be a negative as far as I am on a chart. You don't have that type of pattern on XLE. This is a bear market pattern that hits the Bollinger Band, bounced. It is oversold. While both numbers today are under 20 and they were under 20 yesterday, the day before they weren't. You need a third day to embed. Got to see what it does tomorrow. QQQ, oversold market, lower highs, lower lows. I'm going to repeat. You haven't hit a lower Bollinger Band since March, if I'm correct in this market. And now I've got a confluence of the 100-day average and the lower Bollinger Band. They've come together right here. So anything in that area, I think you're going to attract at a minimum heavy short covering. Doesn't mean I'm right, but that's what I think. As for new buying, somewhere between there and this 200-day is where I'm expecting them to start the buying. Again, you have a lot of people that miss these moves. They're sitting here, they've been waiting to come in. Has anything really changed in tech that much other than they got overvalued? No, still the plays. At least that's what I keep hearing, right? That's what you keep hearing, I'm sure, too. In this market, you had an outside day down today, therefore today's high is key. So when you look at the emerging market, to tell me that the market's run a course where you may not get down to the 200-day or the 100 that high. Let's assume you drop and you don't do that. I'm still going to look for people that want to say, I still like those emerging markets. Where do I think I should come in? Well, a lot of traders hone in on that 200-day average of closes. It's a one-year average if you think about it, and they really look at that in a hard way. So I will not be surprised to see short covering come into the market on a break there. In gold, the gold market is now broken out of this sideways action. It's the way you've got to look at it. And now that it's done that and it's staying under the Bollinger Band, you're under it today. Yesterday, the market was at 178.65 under the band. The day before, the market closed at 179.52 under it. So you have 3 days in a row under the Bollinger Band. 5 is pushing it right to the point where the rubber band normally breaks. So I can see a further decline tomorrow. I look for support in that 100-day average. And again, you might see that that's where the shorts start coming into the market to cover. But this is a breakout to the downside. There's nothing bullish on this chart. This chart, other than being oversold, I can't think of anything else that is friendly on that. The gold miners went through the 100-day average today. So is it on its way to the 200? It's going to be the question. The trend is down. We were dead right here in the analysis I was giving you. You're caught in the sideways action. You get false moves to the downside and the upside. You got to wait for the breakouts. And now you're in that breakout mode. So on rallies back into the upper Bollinger Band, we'll see what the lower band, we'll see what happens. It is not a buy. It is not embedded. Market that is in liquidation mode, a heavy one. TLT, where's all the buying if people are panicking about markets? They're not. You would see bids coming into this, the 20-year and so on, and you're not. They're just flat. The Fed's got the markets back. Nothing's changing. The Fed's not going to raise rates out of left field, and they're not going to break rates further until they feel they have to. They're prone not to go to zero. They've told you that already. So you're drifting in these markets right now. In the euro currency, this is a trade that people got very wrong. Real wrong. I read bank reports and so on that were looking for this market, if anything, to carry much higher. They were looking for the euro to be a stellar performer towards the last quarter of this year now. And instead, the market's breaking down, and that's not pretty. So you've got 2 days under the lower Bollinger Band. You're oversold. It is both days we're in the lower quadrant. You'd have to get back over these highs to scare the bears. I think that if you get rallies, anything in that 18-day average of closes, you're going to find bears are going to be very emboldened. And they're not going to just get scared off 1, 2, 3. And I think, again, it's the COVID situation. But when you get these intraday moves that are all over the board, I know that there's a whole family of you out there that like to be in and out of the markets. I get it. I understand it. There's a popular tool for it called pivot points. At the very least, take a look and understand it. I created a 3-part video series that explains what this is. You tie the formula together, and your charts do it. I've not seen a serious piece of charting software that doesn't do pivot points. Tie together with it the slow stochastic study, and you can go to fast or slow stochastics depending on your thought for day trading, and away you go. So I put this together. It's free. To get it, it's simple. Just go to our website, www.iraepstein.com. On the bottom right, you'll see free offers. Click on it, fill out what you want. We'll get it right to you. I'm Ira. You have a great day. You might want to be looking at my Spider ETF subscriber videos. They're real important right now. Take care.